We are happy you are here because we firmly believe that having precise financial knowledge can benefit you. We're debunking some common misconceptions about investments today in an effort to help you make the most of your financial journey. Let's begin by separating fact from fantasy then. Myth 1. Investing is only for the wealthy. The first myth asserts that in order to dip your toes into the financial pool, you need a sizable bank account. But I'm here to tell you that's completely untrue. Everyone has access to investing as a means of achieving financial success. It is not just for millionaires. There are investing options that are appropriate for all income levels, regardless of where you are in your financial path. Consider it in this way. Over time, even little, consistent donations can add up. It's similar to sowing seeds that blossom into strong trees. It's important to protect your financial future, and investing can help. The world of investing offers a wide range of possibilities, including mutual funds, exchange-traded funds, ETFs, stocks, and bonds. With the help of these instruments, you can invest your money and possibly generate returns over time. Making decisions that are well-informed and consistent with your goals and risk tolerance is key. Investing can help you achieve your goals, whether they be to increase your wealth or save for a specific purpose. And what's this? There are innumerable success examples of people who began modestly and amassed significant fortune via methodical investing. Start where you are and make a commitment to consistent donations. That's the key. Let's dispel this rumor for good now. Everyone may control their financial future with the help of investing. It is not just for a chosen few. Don't let the false belief that you need a wealth prevent you from fulfilling your dreams. It's your time now. Start looking at your possible investment possibilities. Making decisions that are in line with your goals requires you to make use of resources, research, and professional guidance. Keep in mind that investing is a journey, and each step you take will bring you closer to achieving your financial goals. So let's bust this myth together and embrace the power of investment. Myth 2. Investing is just like gambling. The second myth asserts that investing is similar to gambling in a casino. But believe me when I say that this myth is completely false. Contrary to gambling, investing is based on analysis, research, and well-informed choices. Making strategic decisions based on information and understanding is what makes it about strategy rather than chance or blind luck. Consider that you are thinking about investing in a business. You would examine its financial health, market trends, and growth possibilities, rather than putting your faith in luck. Investing differs from speculating in that it takes a well-informed strategy. True power comes from knowledge in the realm of investments. You can decide more carefully if you know the basics of the businesses or assets you're investing in. Although risk is a component of all investments, it should be kept to a minimum by research and diversification. It's similar to placing calculated wagers as opposed to playing the odds. Successful business people don't just rely on luck. They are well-informed, keep up with industry developments, and base their decisions on thorough thought. Consider this. Would you prefer to let luck determine your financial future, or would you prefer to gain control through wise investing? The solution is obvious. Through wise investing, countless people have increased their fortune. Instead of taking a chance, they wisely chose their actions, which eventually paid off. Let's dispel this rumor for good now. Investing is a planned approach that requires knowledge, analysis, and patience. It is not a gamble. Investing is more like a game of chess than gambling is like a game of chance. Every action is thoroughly thought out, and every choice has an impact on the result. As you proceed with your investing, keep in mind that well-informed decisions are your best allies. Take on the world of investing with assurance, knowing that the choices you're making are in line with your financial objectives. Myth 3. You need to follow trends to succeed. The third myth asserts that the secret to success in investing is to jump on every popular trend. However, I assure you that mindlessly pursuing trends can actually hurt your financial progress. While keeping up with market trends is vital, making all of your financial decisions based on trends can be dangerous. Trends can be erratic and transient, and investing without conducting adequate research can result in disappointment. A solid base of knowledge and strategic planning is the cornerstone for sustainable investment success. Focus on building a diverse portfolio that is in line with your financial objectives and risk tolerance rather than buying the latest, greatest item. By distributing your risk, diversification puts you in a position for long-term growth. Consider this. If you place all of your eggs in one basket, a sector slump could have catastrophic effects. However, by diversifying, you are better able to withstand market turbulence. Successful investors keep a steady course based on study and analysis rather than hopping from trend to trend. Never forget that real economic growth is a marathon, not a sprint. Think of the renowned investor Warren Buffett, who is renowned for his methodical technique and long-term outlook. His success is not based on following trends, but rather on spotting reliable businesses with long-term worth. Let's dispel this rumor for good now. Understanding your objectives, completing in-depth research, and having a defined approach are all necessary for investment success. Myth 4. Timing the market is the key. The fourth myth asserts that you can find untold wealth if you can forecast market ups and downs. But I assure you that this myth is not at all true. Even for seasoned investors, consistently timing the market is a very difficult undertaking. A wide range of factors affect markets, making precise forecasting next to impossible. Similar to trying to predict the weather, there will be instances when you get caught in a downpour that you weren't expecting. The key to successful investing is to avoid trying to predict the peaks and troughs of the market. It involves choosing a course of action in line with your financial objectives and risk tolerance. Even if you could timing the market precisely, you would still need to do it regularly. Gains and losses could both be reversed by one poorly timed action. Focus on time in the market rather than market timing if you want to succeed. Long-term stock market trends historically have been upward. You may be able to generate positive returns by maintaining your investment and enduring market changes. Here, compounding strength is put to use. Over time, a patient, long-term investment strategy can provide enormous growth. Let's learn from the illustrious investor Peter Lynch. He once observed, investors have lost far more money trying to predict or prepare for corrections than has been lost in actual corrections. Trying to time the market, in other words, can frequently result in missed chances and increased stress. Let's dispel this rumor for good now. Creating a plan that fits your goals, sticking with it through market ups and downs, and adopting a long-term view are all necessary for successful investment. Myth 5. You need to watch the market constantly. The fifth myth asserts that keeping up with market news is necessary for successful investing. But believe me when I say that this fallacy can cause exhaustion and rash judgments. While keeping up with the market is crucial, it can also cause emotional reactions and rash judgments. Markets can be unpredictable, and brief changes are frequently unimportant in the overall scheme of things. Imagine constantly checking your phone. It is not a prescription for financial security. It's comparable to trying to navigate a ship through a storm while changing course frequently. Successful investors have defined goals, develop a well-thought-out plan, and occasionally examine their portfolio instead of incessantly watching the market. Consider this. Benjamin Graham, a renowned investor, emphasized the significance of Mr. Market, a made-up character who provides prices every day. He fluctuates between being extremely cheerful and pessimistic. Smart investors avoid letting Mr. Market's mood swings influence their choices. It's crucial to make a plan and follow it. Daily market changes shouldn't affect your choices if you're investing for the long term. Consider this. Constantly keeping an eye on the market is like to watching a kettle of water while it waits to boil. It won't speed up the process, and all it will do is increase your anxiety. Let's dispel this rumor for good now. Having a well-defined plan, sticking to it, and regularly assessing your portfolio to make sure it's in line with your objectives are the keys to investing success. And there you have it, folks. 5 common investment myths thoroughly debunked. Remember, knowledge is power, and by dispelling these misconceptions, you're already on the path to becoming a smarter, more informed investor. If you found this video helpful, give it a thumbs up and share it with your fellow investors. And don't forget to subscribe for more myth-busting financial content. Until next